Everyone is saying silver is crashing, timelines are full of panic, red charts, and bold thumbnails screaming sell now. But what if this silver price crash is not real at all? What if it's carefully designed noise, and while retail investors are scared out, someone else is quietly buying in massive amounts? In the next few minutes, I'm going to show you data that most people are not talking about. Charts that don't match the headlines, and a global price gap that raises a serious question. Is silver really weak? Or is this one of the biggest fake crashes in the market right now? Before we go deeper, if you like market analysis that cuts through fear and focuses on real data, make sure you like this video and subscribe to Market Lens. It really helps the channel grow, and it tells YouTube to show you more content like this. Now let's break the illusion. Right now, if you only look at the paper silver price on your screen, it feels ugly. Prices look stuck, momentum looks weak, and sentiment feels heavy. Financial media is pushing the same story again and again: slowing demand, higher interest rates, strong dollar, silver has no reason to rise. This narrative is comfortable, simple, and very easy to sell. But markets are rarely that simple, and silver especially has a long history of misleading price action before major moves. Here's the first thing most people miss. The silver price you see on charts is not the price of physical silver. It's the price of paper contracts, futures, options, derivatives, promises. For every ounce of real silver, there are dozens, sometimes hundreds, of paper claims trading back and forth. When paper selling increases, the price falls, even if physical demand stays strong or even rises. This creates a disconnect, and that disconnect is exactly where the story gets interesting. Let's talk about the global price gap. In the US and Europe, spot prices look weak. But when you look at physical silver premiums in Asia, the Middle East, and parts of Europe, the story changes. Buyers are paying well above spot just to get delivery. Dealers report longer wait times. Mints are running close to capacity. If silver were truly crashing, physical silver should be easy to find and cheap everywhere. But that's not what's happening. Now look at who is selling and who is buying. Retail investors are reacting emotionally. They see red candles and sell. That's normal. That's human. But institutional data tells a different story. Large commercial players, the same ones who usually position early, are reducing short exposure and slowly increasing long positions. This is not loud buying. This is quiet accumulation. And quiet accumulation usually happens when prices are boring, not when they are exciting. Another important point is industrial demand. Silver is not just a metal for investors. It is essential for solar panels, electric vehicles, medical equipment, electronics, and data centers. Even with economic uncertainty, global silver industrial demand remains historically high. Green energy alone continues to absorb massive quantities of silver every year. A real crash would require demand destruction, and we simply don't see that in the data. At the same time, supply is not growing the way people assume. Silver mining is mostly a byproduct of other metals like copper, lead, and zinc. That means even if silver prices rise, supply cannot quickly respond. Many miners are facing higher costs, tighter regulations, and declining ore grades. This creates a slow but real pressure under the surface, even while paper prices stay suppressed. Now let's address the psychology. Fake crashes work because they feel logical. When everyone expects something to fall, it feels safe to sell. But markets don't reward safety. They reward positioning before consensus changes. If you zoom out on the silver chart, you'll notice something familiar. Long periods of sideways movement, followed by sudden, sharp moves higher. Silver doesn't trend smoothly. It compresses, frustrates, and then explodes. This is why fear-based selling dominates headlines. It keeps most people out of position. Meanwhile, those who understand the difference between paper weakness and physical strength stay patient. They don't chase candles. They don't panic on dips. They watch inventory levels, delivery data, and long-term demand trends. Ask yourself a simple question. If silver was truly in trouble, why are governments, central banks, and large industrial buyers not dumping it? Why are long-term contracts still being signed? Why are physical premiums refusing to collapse? Markets leave clues, but only if you know where to look. On Market Lens, we focus on these hidden signals, not surface-level noise. We don't predict exact dates or promise quick profits. We look at probability, positioning, and incentives. And right now, the incentives do not align with a real silver collapse. Another layer to this story is currency risk. As debt levels rise globally and confidence in fiat currencies weakens, hard assets quietly regain relevance. Gold gets the spotlight, but silver often follows later and faster. Historically, silver tends to lag gold early in the cycle and then outperform when momentum shifts. That lag creates boredom, and boredom is exactly what shakes weak hands out. Let's be clear. This does not mean silver will skyrocket tomorrow. It does not mean there is zero downside risk. What it means is that the narrative of a silver crash is overly simplified and possibly misleading. Price alone, especially paper price, does not tell the full story. Smart money rarely buys when everyone is excited. It buys when everyone is distracted, fearful, or convinced nothing will happen. Quiet accumulation doesn't make headlines. Panic does. If you've watched this far, you already see why this topic matters. And if you think more people need to understand the difference between paper markets and physical reality, share this video. It helps others see past the noise. I'd also love to hear your view. Do you think silver is genuinely weak? Or do you believe this is another fake out before a bigger move? Drop your thoughts in the comments. On Market Lens, we read them all, and your perspective often shapes future videos. Thanks for watching. Stay curious, stay patient, and I'll see you in the next one.